We are back with another installment of our performance and market update for our cash and income solutions. As the effects of the previous interest rate hikes permeate through the economy, it was much to our relief as consumers and investors that after 10 interest rate hikes, the Reserve Bank's Monetary Policy Committee left the repo rate unchanged at 8.25% in this quarter's meeting. With that sigh of relief, let's see how our cash and income solutions fared in the third quarter of 2023. The first of these solutions is the Momentum Money Market Fund. This fund invests in short-term fixed income instruments issued by banks, SA government, and SA corporates with a maximum term to maturity of 13 months. With a focus on high liquidity and management of interest rate risk, this fund makes an attractive alternative to traditional call accounts and fixed deposits. While short-term interest rate levels in the country have been a sore point for consumers, the positioning of the Momentum Money Market Fund allowed it to take advantage of rising interest rates despite them reaching their peak point in 14 years. Our increase in our allocation to prime-linked notes helped the fund reset more rapidly to higher yields as interest rates rose. Depicted are the fund's returns relative to its benchmark and peers over various periods. This strategy has proven beneficial to our clients as the quarter-on-quarter performance was 6.4%, rising it up to 2.17% in quarter 3. Furthermore, the fund outperformed both its benchmark and peers across all periods. Our second cash and income solution is the Momentum Enhanced Yield Fund. The Enhanced Yield Fund is quite similar to the Money Market Fund in that it is a low-risk, domestic-only and liquid fund. However, its relatively wider investable universe allows it to provide income in excess of bank deposits and money markets. The positioning of the fund in floating rate instruments as well as fixed rate instruments aims to capture the high interest rate environment. On screen is the fund's return relative to its benchmark and peers over time. The Momentum Enhanced Yield Fund also outperformed its benchmark and peers across all periods. In addition, the fund is a top quartile performer and has ranked 8th out of 43 funds in its peer category, the SA Interest-Bearing Short-Term for quarter ending September 2023. Lastly, we have the Momentum Flexible Income Fund, our flagship income fund that provides diversification across the fixed income landscape. Currently, the Momentum Flexible Income Fund is largely exposed to government bonds, but has also allocations to inflation-linked bonds, property, as well as cash. September was another tough month for nominal and inflation-linked bonds, returning a negative 2.37% and negative 1.09% respectively. Bonds continue to have a challenging month as the market struggles to figure out when interest rates will stop going up due to the uncertainty created by the monetary and fiscal authorities around the world. Locally, bonds are currently driven by news flows around the state of our government finances. We are finding good nominal and real yield opportunities on the bond curve as the elevated yields on offer in the market have already priced in a lot of the news that we hear. Furthermore, we have increased the position in property equity in this fund due to the attractive valuations and return expectations priced into this asset class. We take this exposure through an allocation to the Momentum Property Fund managed by the Momentum Investments Property team. With all the developments in the fund, let's see how the fund has performed. As depicted, the Momentum Flexible Income Fund outperformed its peers and benchmark for the quarter. The 6-month figure, however, still reflects the difficulties reported in the previous and current update that the fund experienced. Our 1- and 3-year figures show that we are still able to provide returns in excess of local inflation. Our aim with each of the funds in our income range remains to cater to your clients' liquidity, capital preservation, and income needs across the investment horizon and risk tolerance spectrums. If your goals have not changed, we encourage you to stay the course. On screen is a visual representation of the importance of staying the course. The orange bars represent the value of the portfolio given how long the investor stays invested. The grey represents missed opportunity as a result of deviating from the investment goal. In 2020, the second best day happened immediately after the second worst day. An investor would have been disadvantaged if the investment goals were abandoned on that second worst day. To further drive the point home, investment returns are 93% lower if the 60 best days in the market are missed. It is quite clear that timing the market comes at a price. While our update has shown that we are steadily navigating the current economic environment, it is important to remember that all the information presented should be seen in the context of the investor's overall investment plan and time horizon, and not as a market timing or asset allocation decision.